really excited about this panel, and I want to just start by citing a couple of very high-level statistics from about the carbon market and investing from our friends at Trove, who recently released a very good report in September with some facts and figures. So figure number one, 36 billion of investment into carbon projects between 2012 and 2022. Of that, 50% of that investment was over the last 3 years. Going forward, 3 billion already pledged into carbon. 18 billion of capital raised for carbon credit funds in the last 2 years, majority of it nature-based and nature-focused. Trove also tells us that, however, the current rate of investment in carbon credit projects is only 1/3 of the level it needs to be to deliver the volume of credits required by 2030 under the agreed upon 1.5 degree Celsius goal. That would necessitate a further $90 billion of capital investment. We got a lot of work to do. So with that, what I want to foster over the next 30 minutes or so is a hopefully interactive and informative discussion that talks about how do we get institutional capital moving at scale to get us closer to that $90 billion number. So Julie, let's start with you. When a corporation or a project needs money, they usually start by calling their bank, a tried and true history of dealing in our markets. And banks have a vast network of institutional investor relationships. Banks have deep expertise in credit analytics. I was an investment banker for 20 years before moving to Flowcarbon, so I know the mechanics of how this works. So can you talk to us a little bit about your view on the potential for the largest banks in the world to help unlock greater sums of capital into carbon credit generating projects?
Sure. I'll try to boil the ocean into a couple takeaways to answer that question. Certainly, as we've heard in the progression of conversation today, one obvious place that banks will come into play is being a market maker and helping as there's more transparency around these markets, how can they bring more capital into it? I think that's a evolution of where we're going to move to. What they also all can be good at is bringing together different pools of capital to invest in emerging technologies and projects. But I think where the first call often happens, as Martin said, is I need capital for a project, I'm calling my bank, I'm probably expecting my bank might be willing to lend to me for this project. And I think that that is where a lot of the challenges overall for the market for carbon credits needs to be tackled to really unlock the ability of banks in traditional sense to lend to these projects around technology risk, counterparty risk, the verification and the transparency through the production of the credits and their life cycle. But what we're seeing and where across the spectrum of the types of credits that exist, where banks are likely going to be able to apply their own credit expertise are things that are closer to and aligned with a business's own technologies and core operations. And so we're starting to see some of the first opportunities to lend to borrowers where part of their revenue stream is coming from the sale of carbon credits generated from their own technology. But it's not 100% of the business, it's a part of the business. And it's those that are baby steps to start getting credit officers and banks getting more transparency on that progression.
Fantastic. And Zach, kind of staying on a little bit more of the traditional finance backgrounds, you have an extensive experience working in the power sector, the energy sector, renewables. You've worked at banks, now Trafigura, and you also have a very unique insight as to how demand informs supply and how supply informs demand. And I'd love to get a little bit of your take on where you see the future with respect to some of the largest institutional pockets of capital, whether this is insurance capital, pension capital. What's your view on the potential for those more traditional pockets of capital to play a role in this market?
Absolutely. So we're dealing with a little bit of a circular problem, right? And that is that, as you all know, and here in the audience, I think, there's not deep forward markets for these products. And so when we talk about investing in a project and looking at an ROI and understanding your exit strategy, understanding what you can hedge, right? It's very problematic today, right? And so I think as we start to see, I think there needs to be a bit more momentum. We probably all agree on this. There needs to be a bit more momentum from companies that are making these net zero commitments to start working on that trajectory, right? So firms like mine, we do warehouse a lot of this risk. We de-risk a lot of products. We do take on risk on the forward curve that doesn't really exist, you know. But for this to really scale, right? You know, this is what we need. The other tricky thing in these markets, or at least that I find tricky, I don't know, is that you know, you have the traditional risks of any other project, performance risk, technical risk, right? Permitting, all these things. But often, frequently, you have quite a bit of sovereign risk as well, depending on where the projects are located, right? And so, you know, I think another thing to think about in these markets is, you know, how do you partner with somebody, you know, in this space that can help you navigate some of these things, right? And it's probably not just one entity, maybe it's two, I don't know. But certainly, you know, we call it, you know, stroke of pen risk, right? When regulations kind of change overnight or an election happens overnight, right? And so these are all things that need, I guess the crux of my comments are about de-risking these projects and the need to find the right partners to work with to help do that so you can comfortably deploy capital at scale.
Fantastic. And that's actually a really good segue into our next two commentators, starting with Gabriella, who come a little bit more from the smaller sums, but in aggregate, very critical sums of money in terms of family offices and ultra high net worth individuals. And you know, at CREO, Gabriella, you're routinely evaluating climate and carbon investments, and you know, you're leveraging your particular expertise in nature-based projects to help connect family offices and their investable balances with impact. And one of the things we often think a lot about at Flowcarbon is so many of the projects that we're helping out typically need capital in the amounts of 5 million, 10 million, 15 million, 20 million, you know, seemingly very good bite sizes for family offices and how they think about investing. And would love your perspective on the role that family offices play in this market, whether taking that, you know, first step into, you know, more complicated markets, more nascent markets, and what's your experience to date been with carbon investing in the family office community?
Yeah, thanks. And that's a really good question and one that I get quite often. So I think it's worth just taking a quick step back and noting that, you know, yes, in aggregate, our family offices, you know, are no match for the large institutional investors in terms of total dollar values deployed. But the specific community that we do work with at CREO is one that's squarely focused on catalytic financing, right? So of that 1 trillion goal, right, that's not all going to come from our members' portfolios. That's going to be in partnership with large financial institutions. So one thing that we're always asking ourselves as a community is, how is this investment de-risking further follow-on capital? Where that tends to work well is in enabling technologies, in large pooled fund instruments that are using, you know, that are developing a novel fund manager who has a lot of talent, who has a good reputation, but just needs that first fund check. It's harder for our families to be backing individual projects, even if the dollar size amounts fit with their equity investing portfolio, because the risk is so concentrated and because they're very concerned with the longevity of the value of that carbon. This has gotten particularly acute in the last year or two. I think downside risk is a major concern. There's also a lot of risk around, or a lot of concern around policy risk and the longevity of the VCM in general as compliance markets start to gain teeth and grow worldwide. So as a family office, they have a long-term view. There are certain areas where they're willing to take on outside risk relative to the other, you know, the ecosystem of institutional investors, and there's other areas where they do want to have parsimony with where they're putting their capital because they're trying to steward their pool of capital for the long term. And this is one area that has been quite challenging. Now, where are they acting? We are seeing a lot of families start to explore carbon strategies as part of their real asset fund strategies. Can be yield generating. It can enable conservation activities that are not economic in the absence of those funds. So we're talking a lot with our membership around, you know, how do you integrate carbon finance, conservation finance into your forestry strategy, into your mixed real asset fund with agricultural holdings. And then we're also having conversations with our families around things like nature tech, enabling technologies, novel exchanges, tokenization. So early stage incubation of technologies that will have outsized impact as they grow. And then as these sort of fundamentals of the market start to mature, and there's novel ways of off-taking risk, you know, through new insurance mechanisms, through securitization, that's when I think our families are going to feel more comfortable coming in and backing a carbon fund directly, right, which has a portfolio of holdings.
Fantastic. And Max, terrific having you here on the panel because you represent the philanthropic side of this community, the foundational asset side of the community, and many of us in this room have seen a number of catalytic investment vehicles. Prime Coalition is one. Tip of the iceberg organizations that are really trying to provide that demand side that's so necessary for us to grow as a market. You also work with many reputable charitable organizations. How do you see the role of those pockets of capital fitting into this discussion? And more specifically, the one important question that we always think about and hear a lot is, can nonprofit organizations work together with for-profit investors in a constructive manner to exponentially grow impact?
Absolutely. Yeah, so I'll start by just talking about a couple of the challenges that I see that clients I advise are working through in the space, and then a couple of the paths forward that I think are really promising. So, the first one you named at the start, Martin, which is scale. When you think about the check sizes that are required as these projects get larger, and then the total of 90 billion as a target, philanthropy can only be a small part of that. We're talking 1 to 10% of the capital stack for a lot of these projects. And the second is additionality. That is, how can philanthropy have evidence that what they're putting into the project is actually changing the outcome relative to the world without them? And it's not just subsidizing, to your point, private investors with philanthropic capital. And one lever for that's obviously doing that analysis to say, is there really a funding gap on this particular part of the project? That can be very project by project, and it's a big barrier. I think another lever that's talked about less but is really important is also just creating some upside for those philanthropists so that they can get compensated if the deal goes well and take it into future projects to recapitalize funds that are investing to get more of this off the ground. So in terms of paths forward, I think one way that this is really playing out is for folks to just go early. And in some cases on the tech-based carbon removals that I've spent a lot of time on, that looks like funding feed studies where there's a gap in the market and companies are actually really struggling to put that together for a project that's really risky. One of my clients that did this in the geothermal DAC integration space put up a $2 million initial chunk of funding for a project to do that first engineering study, and that's now leveraging federal funding and others to really get to the scale that they wanted to see that was too large for philanthropy. I think another place is really for philanthropies to go together. And the PRIME effort that you mentioned, Prime Coalition's Early Climate Infrastructure, is a great example of that. That's dozens of donors around the table really thinking with Prime's expertise on blending different types of capital about how they could pool a bunch of these projects together. But I think the biggest challenge I've seen across that and a number of other related tables that I'm a part of is, how do you actually take that and fold in not just philanthropy, but all of the other representatives of institutional investors that are sitting here? And philanthropy has had a really hard time with that. I think each foundation has their own strategies, and each project has this different risk profile. And so I've actually seen a fair number of one-offs that I think are just subscale for then really getting that follow-on capital from larger institutional investors. So to me, standardization really matters for that. Really getting a clear understanding among philanthropists of what is the kind of relevant deal size, relevant deal flow, return profile that's going to attract that next step of larger institutional investors, and working backwards from there so that they're not just doing one of those projects, they're doing 10 or 20 or 50 in a pooled setting. And that's, I think, really the next kind of frontier of where philanthropy has to go to make that table not just about donors, but about the broader market that it's bridging into.
Yeah, very helpful. Sophie, Eurazeo is recognized as a leader in CSR and capital investment. I didn't mention this at the start, but importantly, you also advise the EU and the French government on ESG issues. Can you speak about the shift that you've seen in how investors and portfolio companies are engaged in this discussion around climate change? Would love your perspectives on this discussion.
Sure, and I must say it's a great panel because we've got all the 360 view of this topic. So one word is really striking out. It's risk, 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 risk. You've all been saying risk. And as much as your data was extremely impressive, we have billions, trillions of capital fueling, and sorry for the word, funneled to decarbonization projects. Yes, we should ban the word fuel, of course. And the thing is, there are various types of products, there are various types of projects. Nature-based are probably the more most risky. We've been studying them very much in depth. They're very risky because of geopolitical issues. They're also, they embed all the physical risk. And you know that I come from a continent which is highly regulated. So we have a burning question right now. Who is going to pay for the carbon that is released in the atmosphere when there is a huge wildfire? So you know, you're financing a project, you're putting thousands of millions to finance a Naturebased project, you're super happy, super proud, and then bam, you have a wildfire, and all the carbon is released in the atmosphere. So we're very, very cautious with those Naturebased projects. And I would say as much as they are crucial, they're also financing what we believe is a common good, and they're not delivering the type of return we're looking for. So that's where I believe we need to be innovative and to do what we call blended finance. And for me, it would be a double perspective on what is called blended finance. Probably it's a mix of private and philanthropic capital. And it should be also a mix of type of projects that we can finance. To give you a real-life example, probably a part of the portfolio could be nature-based projects where you have risk and probably lower return. And then you can add, you were mentioning technology, for example. You can add some other type of assets so that you're going to secure or at least improve your risk-return profile and then make it, I would say, more palatable for investors like the type of company I work for. On the other hand, what we've been financing so far, we are financing decarbonization funds. So we are, for example, financing through a debt vehicle the decarbonization of maritime assets. We're decarbonizing by 20%. So it's significant considering the technologies available. We're, of course, like you guys, financing renewable energies. And today we also want to broaden the conversation. You know that Europe and France has been, you know, very early on in the game of fighting climate change. It's not called the Paris Accord for no reason, you know, so we've been fighting this for a very, very long time. But carbon is only one aspect of the question. And for the last 20 years, I've been saying we will die faster from a biodiversity and water crisis than a climate crisis. So this is why right now at Eurazeo, we are working on a Planetary Boundaries fund. Yes. And the idea is how can we scale what we call the enablers for transition, the enablers for adaptation. It can be technology, it can be pieces of equipment, because if we're real, we need to adapt. And we also need to embrace those other dimensions. Water is critical, biodiversity is critical, so we also need to make sure that we not only altogether finance carbon-related topics, carbon-related projects, but we also need to embrace water and biodiversity.
No, thank you. Thank you for raising that point around planetary boundaries. And I do think it's important on the one hand to recognize that the VCM, which is the main reason why we're all here today, is a critical piece of the infrastructure, but there's also a larger picture that you importantly raised. One strand I wanted to return to is, Julie, at the beginning, you were talking a little bit about how banks will look at business models and start to fold in the carbon, which is fantastic as a progression in how the banking community is starting to think about it. And Zach, I also wanted to build on that because we all know the demand side of this market is absolutely critical. And you mentioned a Trafigura being a little bit at the cutting edge in terms of thinking through driving markets by taking risk on sheet and trying to drive things. Can you talk a little bit about how you foresee the demand side over the near term, and is there optimism that will evolve to a point to make financing structures more viable and scalable?
Yeah, it's a deep question, right?
Yeah.
I'd just say a couple things about it. The market is in desperate need of standardization, right? And I mean, we can all debate the merits of different types of projects or geographies, whatever it is, but the bottom line is until there's some standards that are transactable, whether it's on the screen or whether it's commonly accepted in the boardroom, whatever it may be, we're not going to see that scale, right? And so you all are aware of many initiatives that are underway, VCMI and others that are working on this thing. But it's been going on for a long time, and we need to get to a place where people who aren't as educated as perhaps those in the room can get comfortable with how do I purchase these products, right, to meet my net zero goals. There's a role for exchanges to play in that. There's a role for NGOs to play in that. There's a role for banks to play in that, right? All of us, right? I will say at Trafigura, we deliver an enormous amount of energy around the world and spend a lot of time with some of the world's largest companies. And so, everything that we're doing on our, call it our carbon front, is to support what our customers are asking us for. And I can just say that the ask so far has been very heavy on removals. It's been very heavy nature-based, but we're also involved in engineered as well. And so kind of our view is, the portfolio approach, a lot of education, and if we can ever get to a place where there's some standardization, or at least some pools of liquidity, then I think we get to a place where this thing can really grow.
Fantastic. Yeah, please, Julie.
Getting people beyond this room comfortable, or the major buyers at the moment, it is all those other pieces within a bank. As I think about these first deals that are coming through, is often the first time the credit officer has even heard of or thought of what is the VCM, and is this price the right price that's been modeled in the financial model or not. And so I think that the conversation and how we bring that transparency and digitalization into this market and standardization is critical to be able to unlock all the other pieces that are important to be a part of it.
Fantastic. Gabriela, one question I wanted to ask you is, we heard throughout the day the importance of the nature-based part of this market. It clearly hasn't benefited at certain points in time from the best PR in terms of some of the news stories. And I'm curious, how do you carry the flag of sponsoring the validity of nature-based projects with a very wide investor base that you represent? And do you see that the nature-based side of investing can continue to be strongly supported by the family office community?
Yeah, this is a great question, and one that's subject to quite a bit of discussion. I'm sure all of you have, seen the Guardian article that dropped a bomb on VCMs. I think, a lot of what has been bundled under nature-based solutions is conflated with avoided deforestation project-based credits, right? Those are 2/3 of the voluntary carbon market for available issuances right now. And there's a reason for that, right? They're nominally the cheapest. They're avoided conversion, so there's basically only opportunity costs that you're theoretically contending with. And so we saw a huge proliferation of these kinds of credits early on because they were so economic, and because corporates were then able to access huge volumes of credits at like $5 to $7 per ton. Now we know that it's not representative of the true cost of operating these projects, evaluating for baseline risk. If you're paying $5 for an avoided deforestation credit, there's probably very little community engagement happening on the ground. There's probably very little monitoring of the health of these ecosystems, of doing threat detection. All of these things cost money, but they're vital to the health of these kinds of projects. The other issue that we're contending with is the fact that when you're working with conservation under a nature-based solutions approach, you have to think at a landscape scale. So you can think about, project, based natural climate solutions on more of a removals basis. That tends to be more valid. It's easy to identify degraded landscapes. You can work with a local stakeholder group to, identify what parcels of their land they want to move into a conservation activity. You can track the regrowth of those plants. For avoided deforestation, you're really trying to preserve the integrity of the trophic relationships within an ecosystem, right? To your point on planetary boundaries and biodiversity, that's a much more complex process than simply evaluating flows of carbon in and out, right? And so I think what we're going to see is sort of a novel class of differentiated premium nature-based solutions removals credits. In addition, we're going to start to see novel ways of funding landscape level conservation, be it a jurisdictional program, which operates at a much larger land area. So you're bringing the uncertainties down, you're bringing the risk of catastrophic fire risk down, you're integrating multiple stakeholders into that process. So we'll start to see more of that. Emergent forest finance facilities, one flagship example of that. Verra also has their jurisdictional standard. But we also have to think about, other financing instruments that will be needed to support holistic landscape level conservation activities to protect, the overall base of the natural assets that we're trying to integrate, which carbon is one thing, but you also have biodiversity, you have water, you have, the spiritual and cultural value of these places. And I think we're going to start to see carbon brought into larger trust funds that are funding natural conservation as one revenue line.
Yep.
And we're going to start to see it accompany other kinds of things like, green bonds, maybe some sovereign direct investments, philanthropy, and be used basically as a way of sort of propping up certain parts of this, but just one piece of a bigger puzzle.
Fantastic. And one question for the panel, so please feel free to jump in. We haven't touched yet in this discussion around the role of incentivized financing. So thinking about the Inflation Reduction Act, thinking about tax credits, thinking in the international jurisdictions, all the incentivized finance. And I guess one question is, how active are you thinking about these tools at your disposal, whether you're financing portfolio companies or whether, I'm sure, Max, on your side on the engineered removal space where, you are unlocking, CapEx requirements that are massive, right, in terms of getting these engineered removals. And I'd love any feedback around where the private sector meets this incentivized financing regimes, what your experience has been.
Maybe I can share
Yeah.
a real-life example with you guys. You know that in Europe we have a regulated carbon market for the most heavy emitters. And we made an investment in a company which we believe is future-proof. And future-proof profitability, is a key concept for asset manager because the products they make, it's in pharmaceutical, is useful. Yet when we decided to make the investment, the company was operating with coal and gas and was paying carbon tax. And so it was back in the days, 2016, we did some carbon stress test. And the price of a carbon ton was €8, 2016. And when we did the carbon stress test to see to what extent the economical model of the company would break, we played with numbers such as €30 per ton, €50 per ton. And we agreed with the management we would come on board and we would finance solely if we had a firm agreement that we would exit coal and go to renewables. 200 million of investments to get there, okay? So quite some money. We had this agreement, we started working, and the carbon market hit €100 per ton 3 years ago. I let you imagine the impact on the EBITDA of the company. And then you get kind of in a struggle, because you still need to finance your decarbonization, but at the same time you're facing some tax which are pretty huge. So this company is going to be fully free of coal next year. We're going to be carbon positive, meaning generating a revenue stream, not for a long time because regulation is becoming more stringent. But long story short, and that was mentioned, what we are doing right now is really making sure, can a company afford its decarbonization? Can we, have, I would say, a nice hill of capex, or is it going to be a wall or a tsunami that is going to break a company? And maybe, last but not least, we all need to bear in mind that as much as nature-based projects are absolutely crucial, I would say a good carbon ton is a carbon ton which was not produced. And we need as much as possible to funnel money to avoid producing carbon and to reduce as much as we can carbon emissions.
Thank you. Max, on your side on the engineered removal space, as I was mentioning in just a short while ago, the capital requirements are so large. And as you mentioned, philanthropy, 1 to 10%, it can be at the beginning. How do you reconcile that you're unlocking something where the financing need is so massive, can it ever get there?
Yeah, it's a great question, and one that basically every donor that I work with in the engineered removal space is constantly asking themselves. I think that as you started to mention, I see public funding and especially loans as just kind of the long-term future for a lot of that. Pretty much around every project, there's conversation about how can this tap into things like DOE loan programs office, what needs to be true to get that, as kind of a part of the scaling trajectory. Because the fact of the matter is, from a private markets perspective, some of these things that have both large capital requirements and really high tech risks, even as you start to build a plant that costs hundreds of millions of dollars, they're not ready yet to really just pencil out from a fully private investment perspective. So I think we need that intermediate kind of step of a combination of loan guarantees and really on the policy side, a lot of support from government lenders. And then I think the question really becomes, how do you use that strategically to retire some of the things like the integration risk that can be really hard when you're looking at, like, say, a massive, there was a great example of a massive plant that was, kind of taking on biomass capture and then hydrogen conversion. Trying to figure out how you make something like that that's going to be approaching $1 billion in capex viable. You want that, kind of step with the government in the middle de-risking it, and then you want to be able to do the next 10 of them through private market. So philanthropy at the very beginning of that funnel, trying to think downstream about how you get the rest of it to work in tandem.
Fantastic. One tension I think about that this market is going to continue to grapple with is, from a more traditional finance perspective, the more bankable revenue streams, the better. But we also deal with the question of additionality and qualifying for carbon credits. Does anyone have any perspective on the balance between, bankable revenue streams and profitability of companies, the ability to generate carbon credits? Any thoughts on that arena of discussion?
Well, I'll just say it's being proven out that if the projects can't clearly demonstrate robust additionality, they're not going to be able to be monetized, right? That's kind of the cycle we're going through right now, right? And so I think everyone's aware of that, but the importance can't be overstressed.
It also comes with the alignment of, these major projects and the technology that needs to happen is the alignment of the engineered removal technology with a broader decarbonization strategy of a large funder that maybe is going to fund it differently than just the monetization value of the credits too. I think the alignment can be valuable.
Fantastic. And then I think maybe we have time for one more question, maybe time for two more questions, which is great. How do you all envision the evolution of the voluntary market over the next couple of years from your vantage point?
I'll just jump in real quick.
Yeah.
This is just anecdotal experiences that we're having. We're working with a number of firms, some U.S., some not, and they're kind of they're realizing everyone got a little distracted the past few years with various things, and they're realizing they're not on track with their decarbonization plans. Now, a lot of the firms that I work with have done, we're talking about internal decarbonization too, have done a phenomenal job, whether it's the tax incentives you mentioned or other things, decarbonizing internally. But they're realizing, they're doing the math, and you guys have all seen the charts where it's like, here's my net zero trajectory, here's internal, and then here's the gap, right? And so, those conversations, I'm not the guy I don't know what the right catalyst for those conversations are for those companies, but those are the conversations, as those conversations happen, that's when this market becomes very real, right? And probably very quickly, because as we saw during COVID, when you see a couple peers in an industry group, right, take action, well, guess what happened next, right? Everyone else piled in. And so I think, even though the market's been through some tough times this past year, whatever it's been, we've seen how quickly it flips. And I'm not saying we should all be crazy bullish, that's not my message, but I am saying once it starts to go, it could go quickly.
Fantastic.
And I'd add to
Yeah,
that,
please.
Martin, if I could. I think also it's heartening the aggressive timeline that, say, the CFTC just commented on earlier, because as a number of panelists before us have spoken about, is bringing this into the language of finance, that if you think about who at those companies, they have the decarbonization goals, but if it's the CFO who now needs to write the check and it's going to be asking the finance type questions or asking for service providers to do that, I think that's also, that regulation or guidelines will be important.
Yep. Sophie, did you want to
Yeah.
add one thing?
Probably the thing is, I share very much what you're saying. Many companies, we have committed to SBTi, and it is so complex. And sometimes even when we want to decarbonize, we don't have the technology. I was mentioning the maritime transportation, for example. Technology is not yet ready, so as much as we want to achieve our goals, we cannot. So question I have about the carbon market is on one word. You said voluntary. There are tax spreading everywhere. So carbon tax are spreading worldwide. You know, it's not anymore nor a French nor a European exception. You have a carbon market in China, for example. You have one in Canada, so it's expanding everywhere. So definitely for me, this is the advocate for having high quality, verifiable credits. And probably we will move from voluntary to mandatory because tax-based schemes are going to make it mandatory for growing numbers of companies. So it's going to be interesting.
Terrific. One more question. Should we take a question from the audience? Or I think we have time for one if there's any. This is great. We figured it out.
So there are no questions anymore.
I think, there seems like there's one question over there. Yeah.
Thank you. So you guys were mentioning a bit of like the regulation and like the risking investments, and there's a lot of biodiversity, there's a lot of climate and carbon that's abroad the US, and it's outside Europe as well. What are investors doing or trying to do in order to actually deploy the capital at scale in this part of, you know, where there's political, governmental risks, and are those partnerships, how do they look like? Who are these players that are deploying actually the capital and getting in charge that the projects are completed?
Thank you.
I'll just take a quick swing at it. I mean, we are very specific about what countries we invest in. And I would say before we invest in those countries, we're typically having conversations at the ministry level to understand truly their commitment and their view on the political risk. It's not always a perfect indicator, but that's how we approach it.
I can also jump in. So there's quite a bit of work that our community does, or individuals within our community, on this question. And one common thing we see for handling this is the use of blended finance funds or even fund-to-fund instruments. So, you know, our families will come in and they'll meet with a diversity of different entrepreneurs or fund managers from the markets themselves that they're targeting, and come in with the knowledge that the capital they're deploying is taking on additional risks that, say, a bank wouldn't take on, or maybe has some strategic partnership in place with the philanthropy or with the DFI, and they come in and they supply sort of you know, concessional capital, but still return-generating capital, or they'll, you know, use their connections and their networks to sort of bring in other individuals who can add on some, you know, creative capital approaches, either through a novel insurance mechanism or, you know, or through the use of some insurance approach as well. So, you know, it's complicated and it requires the right kind of investor that has the appetite for, you know, going into something long term. You know, obviously the community relation piece of this is all going to be critical, and you have to approach that with integrity and with good intentions. But we are seeing it start to become more common. We're seeing people start to utilize, you know, fund-to-fund instruments also as well to sort of deploy capital to multiple different fund managers who are talented, but, you know, don't have the networks or the reputation yet to, you know, fundraise on their own.
Great. Well, thank you very much. Appreciate all your insights today, and enjoy the rest of your afternoon.